Hi, it's Michael Douville again here in Scottsdale, Arizona. It is August 4th, 2015. I just need to get my disclaimers. I am not a licensed financial planner nor a stock and bond broker. I don't have any series licenses at all. I'm a real estate licensed broker here in Arizona for many, many years. I do a lot of investment work. We do mostly cash flow work, and we do pretty involved in businesses. I'm reasonably well versed in most asset classes. So some things that are really bothering me. I just came back from vacation, and quite honestly, I must tell you that people are in the airports. People are traveling like mad. Airplanes are full. We just came out of the Caribbean islands. People were on the beaches, but quite honestly, when my wife loves the shop, when we went through the shopkeepers, I talked to the shopkeepers, and shopkeepers told me that business is down 30 to 40% over last year. Now, you wouldn't think that. There's a lot of people walking, but they're not buying. So that's global. So who cares? I mean, what does this mean? Well, it means that globally we're all interconnected. It means that the people in China are not going to be producing. And when they don't produce, they don't buy things. They don't buy any raw materials. And the raw materials are telling you that you have a global slowdown in front of us. It is right in front of us. There's big words being played out here about oil coming down 40-50%. Well, of course, you have the shale producers. They can't compete at $40. It costs them $60 a barrel. How long can you continue producing when you're losing $20 a barrel every time you take a barrel out of the ground? But here's what's happening with them. They got a lot of money from the junk bonds. So all these high yield bonds were destined for the oil fields. And as high as 40, 50, 60% in the last 3 or 4 years. So really a vast amount of bond money has been used in the high yield asset class for the asset of oil. Of course, I mean, it was a growth industry. It was just going crazy. Now things have turned around. Now, how are things going? Well, these bonds for the most part had insurance on them. And a lot of the insurance money is paying their interest carry right at this very point. But that's going to run out in 60 to 90 days. Then there will be none, and you're going to start seeing defaults. And when defaults start coming, that means they're not paying their bonds. So when they start, it's deflationary. That means that you're taking money out of circulation. You're also seeing commodity prices drop. That's deflationary. We've got copper. Well, copper's dropped 40-50%. Lumber is down. Gold is down. Iron ore is down. Zinc is down. Aluminum is down. These are things that are commodities that are used around the world. Copper is used in every manufacturing in the world, and it's dropping. So who cares? Well, it's going to impact all of us. So we're looking at a reset coming, and I'm quite concerned about it. I've been talking about it for the last 5 or 6 months, 7 months actually. Last year we started removing properties from the market and started selling them. So we're seeing a reasonably large cash position. But let's go further than that, because as you as a businessman, you need to have cash flow coming in, or as an investor or as a retiree, you need to have income coming in. You're not going to get it because business is going to really soften up here. More evidence. Baltic Dry Index is down to a 1980s level, and the Baltic Dry Index is for the shipping containers. We just got a new reading on the shipping containers. It was 82 shipping container ships sitting idle. Now it's 108. That means 108 shipping container ships are sitting without any business, and it's cheaper for them to let them sit in port than to take whatever little business they have and put them at sea. So business is shrinking. You start talking about FedEx. FedEx is saying, and they're starting to warn, that their earnings are dropping. You get places like Rolls-Royce and GE that have the aircraft engines. Their business is softening up. Prices are dropping. The big oil producers are laying people off. Shell Oil just announced 6,500 person layoff. Here in Phoenix, a couple of the majors are saying that we're not going to be. They put hiring freezes on. So I'm telling you, the signs are there. 95 to 98% of the people that I met on vacation did not have a clue. They weren't even concerned. They worked, they got jobs, they had paychecks coming in, but we all know that we're globally connected, and when things start to go down, we're going to have problems. And this time we're going to have major problems. It's going to start in Europe, going to go to China, and it's going to come here. So what can you do about it, and who cares? First off, let's talk about a couple of things. The Federal Reserve is telling us, they're going to raise interest rates. Now, they're saying, they're putting little caveats on, but they keep saying we're going to raise interest rates. So if they're going to raise interest rates, that's just going to be devastating for anybody in a bond portfolio. So if you're not on a fixed rate mortgage now, you really need to go do that. What are you waiting for? You've got this will be your last shot to do that. I don't expect in the outlying years that you're going to see 4, 4.5%, 5%. You're probably looking 7, 8, 9 if you can get it. And quite honestly, if we start having default around the world, like we're looking at Greece, Greece is not the only country that's in trouble. Look what's happening in Puerto Rico. They're not paying their debt. So Puerto Rico has said, we're not going to pay our debt. We're going to go bankrupt. You have oil producers that I think very soon are going to start defaulting on their bonds. That's going to take money out of production. And when money starts shrinking, that means interest rates are going to go up. So as interest rates go up, no matter whether it's Federal Reserve or not, it's really trouble for the bond market. When you have historically low rates, historically low, which direction are they going to go? Do you think they're going to drop another? They're going to go negative? They could go negative, but more than likely they're going to go positive. And there's still a lot of people who are on adjustable rate mortgages because you can get them under 3%. What happens when they go to 5%? Could they go to 5%? Absolutely. Could they go to 6%? Certainly. Could they go to 7%? Yes, they certainly can. But let's just look if they go up to 2%. Say they go to 3 to 5%. Now you know that a lot of that payment is principal reduction, so it's not dollar for dollar. But if you have a 2% increase from, say, 3.5 to 5.5, you're going to have a 25% increase in your payment. So that's deflationary. It's taking money out of circulation. It's also driving prices down. It's going to impact business. So here's what I'm pleading with you to do. My business suffered greatly during 2008. Personally, it didn't bother me one iota. We had income properties. Our income just kept coming in every month, month after month after month. Prices went down. Sure, we weren't selling the properties. What difference does it make? We're more concerned with how much rent do we get. And quite honestly, I'm not advocating land. I am not advocating industrial properties. I am not talking retail boxes. I'm talking about some basic commodity like residential rentals. And here's what I'm telling you. I'm pleading with you. Be prudent. Take half of your money off the market. Take it out of the stock market. Take it out of the bond market. It's at high risk. Take half. That half's probably profits. So take half, put half of that half into cash. But take that half and buy some cash flowing properties. I would leverage them. So I'd put 35 to 40% down on every property I bought and take a 60% leverage position. It's very, very conservative, but you can get 4, 4.5%, 5%. If you are very conservative, which is this video is really set for someone with an assets of maybe $5 or $10 million. So generally a very conservative person. So we would buy a string of single-family homes at 3-bedroom, 4-bedroom, 2-bath, 2-car garage property and just lease those. Those are so conservative they just rent overnight. Maybe the rent goes down a little bit, but it's not going to plummet, and you'll always be able to lease it. Everybody needs a place to live. They're very conservative, and they'll cash flow for you. It's not the asset that's the problem, it's the cash flow. So if you're in business, like I was in business, my business took a major hit because financing became tough. So what you need is an income stream, and that's what we need. That's what we design. So you need that income stream coming in. So you don't necessarily, you can go talk to your advisor, go talk whatever part of the world that you're in. You can find a broker that's near you. You can go ahead and get an income stream, but take half of the half, go buy it immediately, and then hold the other half back. And I'm going to tell you that you're going to have some really great opportunities. Now, I've talked about the 7-year cycle for the stock market. It's due right now, and an 18-year cycle for real estate. But we're probably going to correct. When that correction comes, it's going to take great courage, but it is an opportunity to buy. So hold that half in reserve and then we use that as opportunity cash to buy things that come along. And if we don't catch exact bottom, we're going to catch better than it was, and then we should have a boom come 2020. So here's the strategy. You need to get that money out of the stock market. You need to get it out of the bond market. I don't know what else I can tell you. You need to do that. You know, personally, we're sitting with virtually nothing in the stock and bond market. You know, we're sitting in cash. Last year, we were selling marginal properties to make sure that we're getting ready, because I think we have a buying opportunity. But if you don't have a dependable cash flow coming in for yourself, you're going to be in trouble. And what you'll end up doing is spending your cash that you can't get back. So we want you to spend the return on your capital, which is going to be your cash flow. So that can be designed. There's still very, very good properties available worldwide. Certainly in the United States. I mean, if you're in Silicon Valley, you might have very, very limited. San Francisco, New York. But the rest of the U.S., there's wonderful things to buy. There's other things around the world. I mean, Greece, I'm sure, offers some positions. Spain, you should be able to do some. You should be able to do some great things. But get it out of the equities market. I'd take the whole thing, but just be prudent. Take half. Take your profits off the market, and let's move forward, because the market is slowing. It's globally slowing. And who cares? You should care. So listen, I'm here back in town. Had a wonderful vacation. I answer my phone, so if you want to talk to me or have your advisor call me, we can brainstorm and come up with some ideas for you. So hey, my very best to you, and good luck. Talk to you. Bye-bye.